Well, the insurance market in India is large, it's growing, and from just a pure demographic standpoint, there is further upside opportunity. It is dominated by a couple of large local players, and as you mentioned, quite a number of pre-existing kind of foreign entrants and some new ones. We don't see that abating. I think if we look at how India stacks up relative to other financial centers in Asia Pacific, a lot of global financial institutions are being very careful about their portfolio. They may play in a number of markets, but as you've seen in several examples, there's pullback in a number of markets. Relative to the other markets in Asia Pacific, with our client base, we typically see India as a top 2, top 3 priority country. I think if you look at the North American and the European insurers, they certainly have a home market that they need to protect and gain share in. But relative to the Asian markets, these are much lower growth markets for a whole variety of reasons, which I think you've probably looked at. Now, for most of the global insurers that we're working with, it's hard to find one that wouldn't say that they would not want a larger proportion of their business coming from developing markets. And within the developing markets, Asia is really seen as a very attractive set of markets. I think the thing that's different now versus 5 or 10 years ago is that global insurers are much more selective about the markets where they want to participate in. The changing regulatory environment is critical, and as banks prepare for Basel III, quite often the headlines talk a lot about the need for increased capital, and that's certainly true for a number of the large global financial institutions. As important, if not more important, particularly in several jurisdictions like Europe, the need to also improve liquidity positions. When we look at Basel III, there's both capital requirements as well as liquidity requirements. The net stable funding ratio, which is the key liquidity metric where there will be increased requirements under Basel III, that in particular is going to affect the European banks very heavily. And the ECB has provided ample liquidity for a short period for a point in time. How banks over the long term kind of manage towards a more stable liquidity base in the months, quarters, years to come, we see that as a really critical factor that CEOs and CFOs are focused on today. Entering the crisis, there were some things that made the Asian financial institutions different. The first is that they had very ample capital ratios. So when we looked at the Tier 1 capital ratios pre- and post-crisis in Asia Pacific, many had capital ratios either in the high single digits or the low double digits, quite a lot higher than that of the European and North American peers. The second is most Asian banks were not relying on wholesale funding, so they were self-funding in their domestic markets, and that ample liquidity that they had and still have relative to peers in Europe and North America is a major differentiating factor, and it makes it much easier to grow their business on a self-funded basis. And the third is the balance sheet was a lot less complex. If you looked at who were the largest consumers or producers of derivative instruments, it certainly was not, by and large, most of the financial institutions in Asia. So coming out of the crisis, we see quite a strengthened set of local Asian competitors, and in combination with that, a number of the larger global players have had to be far more selective about the parts of the business in the region that they participate in.